Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, February the 20th. I want to take just a brief minute to discuss what markets did last week, as it was a positive week for the S&P 500, but for the mid caps and the small caps, it was not so. So the S&P 500 last week was up 1.47%, off of some strong earnings of some large cap companies that really powered that index higher. The mid-cap index, as measured by the S&P 400, was off 0.25 or a quarter of a percent, and the small caps, as measured by the S&P 600, were down 20 basis points or down 0.2%. What I really wanted to focus on this week is we've really seen the last 2 years the markets being moved higher by two things: AI, or the Magnificent Seven, mainly the Magnificent Seven large cap. Those are seven large cap growth stocks that have really powered the equity markets higher. And if you weren't there in those names, you weren't participating in the overall returns in the market. So for example, the S&P 500 was up around 20% last year, but the equal weight by the end of the year was only up about 12% year to date. So there's an 8% difference there in those returns. And that's because of the outsized returns of those large cap growth names. As we fast forward into 2025, what we're seeing is potentially a rotation out of that Magnificent Seven into the other 493 stocks in the equity markets. And there has been some fits and starts. Last week was definitely a more growthy week. The tech sector was up over 3%. We had some strong earnings there in that sector last week. But year to date, value is up over 4%, up over 4.5%, while growth is only up over around 1.5% year to date. So quite a difference there, about 3%, and we're only a month and a half in, or almost 2 months through of the year. And that's a great start of the year for the value sector. And I wanted to talk why we may be seeing this rotation. As we have been talking about and expected to come, and it sure has come, is the volatility that we've spoken about. And it's macro level volatility that's causing or macro level headlines that's causing volatility of the equity markets. And the reason why you may very well be seeing a flight away from these high growth names are two reasons. One is valuation. These stocks are priced for absolute perfection. Any type of disappointment is going to lead to a downward selling pressure on those equities. And two, the volatility in the market. When the market becomes very volatile, investors want consistency, and they want something that they feel is a little bit more stable, that can navigate through and won't be impacted as much by the policies or the macro events that are driving the marketplace. So they look to find companies that return capital to shareholders pretty consistently, and a lot of those are the dividend paying stocks. So if you have a portfolio right now consistent of pretty good dividend paying stocks, it's probably performing pretty well year to date, as that has been a flight of where investors have wanted to move capital out of these more growthy names into more stable names until we get a better picture of how these policies are going to impact earnings in the market. Because as we talked about last week, earnings so far have been good. 80% of companies are beating. Guidance is pretty good for the most part. Now, if you are not guiding to absolute analyst expectations, expect a haircut, and you're seeing those equity names get sold off. But pretty quick recoveries afterwards. So if you have questions about how to navigate this portfolio, or this time in your portfolio as we're seeing this shift, and if it's something that you have questions about or we can help you with, feel free to give us a call. We'd love the opportunity to speak to you. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much for watching.